I'm going to give you a quick Beanstalk crypto tutorial and just really give you a tutorial showing you how the whole Beanstalk protocol works, how the Bean crypto works. And we're going to do this by first looking at something like Savanna. This is a typical algorithmic stablecoin. They're very risky, but you can make a lot of money with algorithmic stablecoins. I'll show you why here in a moment. However, they have some inherent flaws, and every single algorithmic stablecoin that has not had some sort of centralized assistance has ultimately failed, every single one of them. However, Beanstalk stands to potentially change this. So let's understand how an algorithmic stablecoin works, and then I'll show you where Beanstalk differs to fix some of the problems that are common. So in this particular algorithmic stablecoin, the SVN token is pegged into a token called MMF. So right now, one SVN token is valued at $1.13. One MMF token is valued at $1.03, which means SVN is not 1-to-1. It's one SVN to every 1.1126 MMF. Right now, SVN is overpegged, and this is when these projects are very, very profitable. So you have the SVN token, which is designed to be pegged to something. Most often they peg to a dollar, by the way, but in this case it's pegged into another cryptocurrency, which is unique. But SVN is pegged to MMF. Right now it's overpegged. They have to expand the supply of the token. But what do? They don't just dump it on the market. That's not going to work. Theoretically, what they would do, they would give those extra SVN to people that are invested in the protocol who want to see the protocol succeed long term. In this case, it's the M shareholders. There's always a share token. There's a logic or a theory behind how this is supposed to work, and then I'll share with you what really happened. What's supposed to happen is the people who own the M share token, right now they're valued at $12,000 each, $13 million in this protocol. There's only 100,000 supply. The idea is if you own the M share token, then you must really believe in this. So they give you the SVNs as a reward. You basically get free money, and it's a lot of money. If you come over here to inside Oasis, or what they call the boardroom on an algorithmic stablecoin, if you had M share, you would stake them here. Every few hours you get your reward. The reward comes out to 2% daily, 732% APR. That's not a gimmick, by the way. The catch, if there is one, is that this M share price can go up and down radically. I think M share has been as high as 20-something thousand or $30,000. It can't ultimately go much lower. It can go down to a few $100s at some point if it wanted to. I think the lowest has been so far is $3,000. That's very volatile. But if you own the M share, then you make the rewards every epoch. Now there's another mechanism here. Everything's fine. That works well as long as we're above peg. But what happens if we fall below peg? Theoretically, the bonds come into play. You can buy bonds with SVN. You got to pull the SVN off the market. So if we're over peg, they put SVN back on the market and it goes to the M shareholders. And this is all done through smart contracts. If they go under market, let's say the SVN all of a sudden is selling for 90% of its peg value. Let's just say that instead of it being at 103, SVN is trading 93 cents or roughly 10% down. Then what would happen is you could use SVN and buy bonds. So you can buy bonds for 93 cents. That's what they would cost. And you would use SVN to do that. When you buy the bonds, you're burning the SVN, so you're decreasing the supply. Once it got back over peg, then you could cash in your bond. The idea being you'd make 10% on your fund. The ability to earn from in-share and to earn from bonds, in theory, should keep this thing pegged. So how come these never work, or they haven't worked yet without some sort of centralized authority? Because most often what happens is there's too much economic freedom here. There's a SVN price that can go up and down, meaning a lot of people can buy a bunch of SVN on the open market and it would take the price up. They can sell a bunch and it would take the price down. M share can go up or down. Bonds can go up or down. There's too many variables here that rely on human emotion. And I think that's exactly why they always lose their peg. Keep in mind, typically when the market starts dropping, people get fearful. They want to sell. So when SVN drops below peg, what's supposed to happen is people are going to want to buy bonds at current market value to be able to exchange them for SVN later. So the idea is using the SVN to buy bonds cheaply. The bonds will go back up in price in line with SVN, redeem those for profit once you get over peg. All too often, what happens once SVN loses its peg, when there's selling pressure, a lot of times what happens is everybody starts selling. And the bond buyers, if enough people don't come in and buy bonds, if they're fearful, and they don't know if it will go back up. And then it gets further and further away from its peg. Maybe it's selling for 90% of MMF, then it'll sell for 80% of MMF, then it's 70% of MMF. And when it gets further and further away from that peg, people just don't buy bonds. And if people are not buying bonds, then there's no way to regain the peg. And then the share prices dump and the whole thing basically collapses. And historically, there comes a point in time when this happens in almost every algorithmic stablecoin. Unless the team is standing by with additional funds to buy up SVN, they can extend the life of it for a while. But at some point, point, it tends to collapse. So Beanstalk is an algorithmic stablecoin, but instead of using M shares, it uses a credit model. This is significantly different for several reasons. One is it doesn't require bonds. When the token loses its peg and it drops below peg, bonds require brave souls to say, hey, I want to buy bonds because I think the peg's going to go back up. Psychologically, they have to make a buying decision for an asset as the price is falling, which is the exact opposite. In crypto, the idea is to not catch a falling knife. You want to follow the trend. But the trend says, if you're following the trend says don't buy bond because SVN is going to keep dropping. What Beanstalk does, their mechanism, when the peg is on point, it has you commit to be able to support the protocol. That commitment is already made and is in place. That's what the credit is. So basically it says, hey, you want some of these rewards? Well, they take half the rewards and they send them to what they call in Beanstalk the Stalk, and then they send the other half to what they call the creditors or the bean pods. And basically the bean pods is like they're waiting for beans. They're empty pods waiting for beans. They're waiting to get paid back. And because of that mechanism, then all they have to do is incentivize people to want to buy beans, because every bean can be turned into a pod at a 1-to-1 ratio, but that pod pays an interest. And at times it pays a very high interest. And that interest payment is available when it's above peg. So let's just take a look at this.
Instead of using collateral, Beanstalk creates economic incentives to coordinate independent market participants to regularly cross the bean price above and below $1. Users of the protocol can receive rewards by helping to stabilize Bean's price through issuing credit to the protocol or providing liquidity. As long as Beanstalk is able to attract creditors, it can return the bean price to $1. By using credit instead of collateral, Beanstalk can issue enough beans to meet the ever-growing demand for stablecoins.
So let's look at this diagram quickly. When you see weather just means interest rate. When you see soil, it means how much debt they're willing to take on. So typically there's a lot more people trying to give debt, like you wait for soil. When it's available, you can buy pods. And once you buy pods, you're basically saying, hey, I want to buy $1,000 worth of pods. And the interest rate may say, you're going to get 50% on your pods. And what happens is those pods or your $1,000 gets put in a line to get paid back. You can see where it's at in line, and it will get paid back over time when the bean price is over $1. When it's over $1, new beans are minted. Half the beans go to the people who provided liquidity in ETH bean or in 3-curve bean pools, and that's inside of what they call the silo. And once it comes live, you'll actually be able to see it. The silo would be like M-share. The bonds would be like the creditors. So once the SVN, once it's over peg, that 2% per day that is paying out right now, half of that would come to people who've staked liquidity. The other half would go to the creditors. But notice, by using a credit algorithmic stablecoin, it encourages people to commit to the platform before the platform is in trouble. This prevents, this is exactly why the whole project is coming back. The amount of people, there's over $100 and something million. I told you at the beginning of this video, there's over $100 and something million in credit that was staked on the platform. That's a lot of people that now have a vested interest to want to be able to see this project succeed. I genuinely believe that's the only reason they've been able to raise money, or they're going to be able to raise money to restart this protocol. The credit model is brilliant. When the price is above $1, weather decreases, meaning interest rates decrease. They don't need to take on as much debt. New beans are minted based on whatever the price was. 50% of those beans go to the silo or go to the people who were staked. What I haven't talked about here is the Beanstalk portion. We'll get to that in a moment. 50% of those beans staked goes to the pod investors, meaning the credit line, the protocol loans. The bean supply has been increased. The price will go down because invariably some people will sell. Once the price is less than $1, interest rates go back up to encourage people to want to lend to the protocol. Soil goes up. So at the end of an epoch, basically there's soil there so people can lend or they can buy bean pods. They can lend to the protocol. More beans get sowed to pods, meaning more beans. You have to have beans, by the way. I said $1,000 worth is $1,000 worth of beans. You use those beans once they're soil to buy pods. When you buy pods, you basically wait for them to get repaid from this 50%. You wait in line. One guy put in $30,000 into this protocol, and I want to say he said he got out $150,000 when his pods, when they came due. He happened to use his beans to buy pods when the weather was really high. When you buy pods, you're basically taking beans off the market, so it decreases the supply. When it decreases supply, it helps push the price back up ever so slightly to get it back to $1. And the cycle can rinse and repeat that way. And the whole goal is to keep the bean price closely pegged to $1. There's another mechanism in here in the silo. When you're in the silo, again, it's a little bit like being in M share. You get 50% of the rewards when it's overpegged when you're in the silo. The thing about the silo though, there's no share price. When you're in the silo, you collect a certain amount of stock, and that stock has its own APY. The longer you stay in the silo, the more stock you get. It grows over time. But stock is not a sellable asset. It is not a token. All it does is it's a representation of how long you've kept your funds in the silo. Whenever you come into the silo, you get some stock and it continues to grow over time. And in the first few weeks or first few months, it actually grows faster than it does later on. It eventually kind of slows down. There's a bit of a curve on how fast you get stock, and it kind of slows down and almost plateaus. What that happens is when you pull out of the silo, you lose all of your stock. So if you want to be able to own a big portion of the earnings in the protocol, then you go into the silo with your beans, you lock up your beans, and you collect stock for being locked up. And the longer you're locked up, the more stock you're going to get. So it incentivizes people to stay there. And you don't have the price fluctuation of this M share. When the SVN loses peg, M share price drops. It's very difficult. That's a strong market sentiment to expect people to suddenly say, oh, I'm going to go buy bonds. I know I've been there. One of the most successful projects I was in, I probably 5x'd my money within about a month. And I thought I was going to jump into bonds. I fully intended, once they lost peg, I was going to jump into the bond section. And this has been 2 or 3 years ago. But I got to tell you, I think I had made like 20 grand on that thing within inside of a month. I think I tried to put $1,500 worth of bonds and I never ever cashed them out. I think the protocol collapsed. As bullish as I was when it was doing well, I thought I was going to drop in like $10,000 in the bonds because I figured I did not know the weakness of these algorithmic stablecoins. And since I've seen that project collapse, I've seen many other projects collapse. It don't mean you can't make money with these things. It just means they historically have a lifespan unless there's somebody around who's going to support the peg that's a centralized authority. They can't be fully decentralized. Where Beanstalk had been working fully decentralized, the economics of it had been working fully decentralized for many months until this exploit. And I'm hopeful that it can continue to work for many months and many years in the future. I think this model offers a lot of promise, and I'm excited to see it do well. Let me know down in the comments, do you think that we need a fully algorithmic, non-centralized stablecoin in crypto? Let me know down in the comments, ladies and gentlemen. Ladies and gentlemen, I'm excited to see where this goes, and I'm excited to be a part of this project.